Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Tuesday, the 28th of September of 2021, and markets are moving, yields are moving. So let's get right to what we're paying attention to, so you should be too. Thanks for watching. So right out of the gate, we've got a lot of headlines. We have markets selling off, big tech being hit by yields rising, and we'll discuss that in a second. And we have also Washington shenanigans. That's not my term. That's the term that's being thrown around, especially early morning on CNBC by one of the guests this morning. That being said, let's get right to the 10-year Treasury and why interest rates rising really matters, specifically to tech. If interest rates rise by the 10-year Treasury, and we just saw this, it also discounts the future value of cash flows. So the present value discount of future cash flows for technology companies. Right now, they've been levered to ultra low and anchored by ultra low interest rates. And a lot of companies on sort of, institutions on Wall Street are in the mindset that we're going to have interest rates lower for longer, and then they sort of build their investment policy thesis based upon that, and they put a lot of basically betting, if you will, in the market sort of towards that. But when interest rates rise at the velocity, and that's the most important, at the rate of rise that we just saw, and the interest rates rose very, very quickly in the last few trading sessions, that catches Wall Street off guard. Therefore, we've seen it in the past. It's not uncommon that if some institutions, financially speaking, that are betting heavily in one direction, markets move against them and move quickly by the velocity, they unwind. And once they unwind, they go bye-bye, unfortunately. And those are the high-risk players. And that then causes sort of waves in the marketplace. Again, we're balanced, we're slow, we're steady. If tech is off today, which we have, big tech for our clients, we also have energy, which is up. We also have financials, which are doing well, and they will continue to do well. The big banks will continue to do well. In fact, they've been waiting for interest rates to rise for quite some time. So our balanced, diversified, slow and steady approach is very important. But also, don't let the headlines of big tech to actually sort of, steer you from your investment philosophy and our process that we have laid out here by any stretch of the imagination, because we are engaged in a process that works and will continue to work on a go-forward basis. We also hold cash for our clients, and we'll take advantage of these volatile opportunities. But what's interesting, as I was doing my morning research, it took me back to, we're closing in on almost 200 episodes of just educational content, real-time, relevant, market-related, updates for you. And as we do that, I was going through an old episode that really talked about this earlier this summer. It was right before 4th of July. And we talked about the danger zone, if you will, of where the 10-year Treasury theoretically could be and what that means to investors. Well, the danger zone I was referring to, and if you follow along at home, I appreciate that you do, we were actually also teasing that the summer release of Top Gun 2 is going to happen, and it never actually happened. They postponed that because they want to wait till audience get in the stands, and they want to get the biggest box office they could possibly get. And you can't blame Tom Cruise for that. But at the same time, the danger zone I was specifically referring to, and this is an old chart. I keep all my charts in the room here to ultimately refer back to them, but also to keep us honest. This is something that we're putting our thought process out there and our thesis out there for our clients, and it's great to revisit this because we did talk about the range of the 10-year Treasury. Now, earlier back in March, we had the 10-year Treasury hit a top for the year of 1.74%, and then it created sort of a short term for the calendar year, a high for the 10-year Treasury. Now we saw it drift all the way back to when my last recording of this, when I originally did this, we were down at the sort of low range of the danger zone, or low range of the 10-year Treasury at 1.48. Well, if you followed along, and I'm sure you have, we saw the 10-year Treasury come all the way down to about a 1.1 this summer. So this is the range that we saw, and then we actually theoretically put in maybe a double bottom. We might see the 10-year Treasury actually create that bottom. It tested the 110 area, and that could be it for a good long time. Who knows? We can't predict the direction of interest rates, but we can always follow the trends, and that's the idea here. Well, Rob, where are we today? Well, we're still in the range, and the range is still sort of the safe zone, if you will, for the 10-year Treasury, even though we're seeing some short-term volatility because of some financial institutions may have been caught off guard because of the velocity, the rate at which the 10-year Treasury just rose. But we're right now at the 154 level, and we're squarely in the range. Now, the key is to be paying attention to is going to be the 1.74 above that. So that's a high for the year. And if we close above that, test it and close above it, that means that we have now entered potentially into the danger zone. And ultimately what that means, we saw it in 2013, 2011, and a few times in a previous sort of market data research, that that's when things get sort of a little bit out of whack in terms of the short-term term premium. Not to get too technical, all that means is that it's a better deal to keep your money in cash than it is to extend it out in the little bit longer term on a treasury at that moment in time. So you're rolling over your short-term money, you're getting a better deal. You're not getting the term premium, because up here, you're getting a better deal just to keep it in cash. Again, we keep cash for our clients, cash-like equivalent, money markets, so on and so forth, to take advantage of scenarios just like this when markets create volatility. Volatility creates opportunity. We still have our base thesis that we believe we're going to wait for corporate earnings for the third quarter to come out. We believe they're going to be better than expected and anticipated, and that will then set up a Santa Claus rally, and markets will rise higher. But we're in that period of time now where there's a lot of uncertainty. Rob, why do we have additional uncertainty? Well, I'm going to go to another chart that I kept from the past, and this is important to look at. And this is one that we used before, which is M&D SNL. And I use this at home and with my kids. I talk about mom and dad savings and loan. And so the bank's closed, or we can't help you out, or you have to sort of, earn that, put some money aside on your summer job to ultimately get what you want, whether it's a new pair of shoes or even my girls getting their nails done. That being said, right now we are in the world of Washington and their shenanigans, right? So mom and dad SNL are basically the fiscal and monetary policy. So you've got Congress trying and racing to raise the debt ceiling and pass infrastructure, as well as pass all the extra spending. And that's another reason why their interest rates are going up, right? So the markets are kind of sending a signal that, wait a minute, we shouldn't be spending all this money potentially. So regardless of what fiscal and monetary policy, and obviously we have Janet Yellen, Treasury Secretary, and Federal Reserve Chairman Jerome Powell, they're both testifying today, and they're both speaking to sort of, will they come to the rescue? Now, the Federal Reserve has been in the forefront for weeks and months now, in fact, the whole year, quite frankly. But Federal Reserve Chairman said today he sort of changed his stance, which is very interesting. In his testimony, when questioned by Congress, he basically said, yeah, inflation may not be transitory, which means temporary. And he basically cited the supply constraints that we're seeing off the coast of LA that we've referred to and referenced here in our daily updates for you at home. So all of this stuff is on our radar. We're really excited because a lot of this stuff is playing to our playbook and our investment policy research and theory, and we are well in hand with regards to navigating through the markets for our clients. That being said, what's the date we're going to pay attention to? Well, in this case, according to Janet Yellen, it's October 18th is when the Treasury needs the debt ceiling to be raised. Otherwise, they're out of money. So they better call the credit card company right now and increase their debt limit so they can spend more or more money that we don't have. Because, we're going to pay it back, right? At some point in time, our kids, grandkids, great-grandchildren will have to pay it back. But in the short term, let's not panic. Let's just pay attention to making certain that our credit card company, could be China in this case, could be other countries, will actually foot the bill as we need to spend more, or at least increase our limit in the short term. So that's our update for today. Thanks for watching, and we'll catch you again next time. Take care.